Hello, I am Carla Zevnik-Seifzer, President of Clearstep Financial. We focus on educating and teaching about money and finance here at Clearstep. I am here today to introduce you to Adam Queering, partner, co-founder at Q3 Asset Management, to discuss some of the key strategies Clearstep uses to help clients grow assets as well as help preserve. Let me introduce you to Adam. He is a wealth of knowledge and experience to the team at Q3 Asset Management. He spent over 20 years working for both traditional and alternative investment firms. He has a diverse blend of quantitative investment strategies to the retail investment advisory community. He was on the floor of the Chicago Board Options, where he worked for proprietary trading groups specializing in equity options. He graduated from Northern Michigan University with a degree in business and holds the Series 65 license. He also played point guard for Wildcat basketball team. All right, with that, I am going to hand it over to Adam. Thank you for being on the call today, Adam.
Thank you, Carla. Appreciate you having me and appreciate the opportunity to tell you a little bit more about Q3 and how we manage money, how we manage risk. We're going to talk a little bit about one of our flagship tactical equity models, Bull Cipher, which is a very popular strategy for both Carla and other advisors at Clearstep. And then we're going to touch on one other strategy as well. And I know Carla communicates with you regularly, but we're always available to answer questions on a one-on-one basis as well. So our compliance department's contribution to today's presentation, past performance is not necessarily indicative of future returns. There's no assurance that objectives will be realized. So to tell you a little bit about Q3, our roots come from the trading floors, as Carla alluded to. Myself in Chicago at the Options Exchange, and my partner here, Brad, who's a little bit older than the rest of us. He started back in 1982 as a runner in the gold pit, Three World Trade. And that's a picture of Brad there in his younger days. And at the time this picture was taken, he had just been recruited by a gentleman named Paul Tudor Jones. Paul was just starting to make a name for himself back in 1984. But Brad got to learn from one of the all-time greats. Paul did very well over the years and kind of made a name for himself. So in the early 2000s, Brad relocated here to Michigan, which is where Q3 is based. He and I struck up a friendship. And today we work with advisors like Carla who believe in active management and the benefits that brings to a portfolio. So what exactly is quantitative investing? Well, the Q in Q3 stands for quantitative, and everything that we do here is based on statistical analysis. And that's just a fancy way of saying that we study historical market tendencies and trends and look for certain patterns that tend to repeat themselves time and time again. And as a result, what we do is we create rules-based strategies. You can think of it as if X happens, what's the probability of Y occurring? And if there's some positive expectation there, we're going to try to take advantage of it. We understand that the stock market is largely influenced by human emotion, which is fear and greed. And that's why you tend to see these similar cycles play in and out time and time again. And again, that's something that we can attempt to quantify and take advantage of. And then with all of our strategies, one thing that differentiates us with maybe a more passive approach, a buy and hold approach, or we often refer to it as buy and hold, is defined entry and exit criteria. So we have rules that determine when we want to be in the market, and we also have rules that determine when we want to be out. And we follow those rules to make sure that we're doing the right thing with our models. So the Q in Q3 stands for quantitative. As I just noted, everything we do here is based on statistical analysis. In doing so, we take the emotion out of the investment process. And the strategy we're focusing on today, Bull Cipher, is really more focused on what we call singles and doubles rather than trying to hit home runs. And that's just a way of saying that, number one, we're focused on preserving capital and protecting what you have. And then number two, we're going to take what the market gives us and try to make money on the upside when the opportunities present themselves. So here at Q3, we offer a variety of different strategies, all of which are actively managed. So you're going to see different styles of investment strategies within your portfolio. What we refer to as the strategic models, those are going to correlate a little bit more to the broader market, whereas the pure tactical strategies like Bull Cipher are going to have a lower degree of correlation. And that simply means there's going to be days where the market is down and you might be up. And there's also going to be days where the market is up and you might be down. So there's this non-correlation factor that these strategies attempt to follow. So just briefly, before we get into the strategies here, talking a little bit about the market and where we're at here currently. You know, we're in December now. We're in the fourth quarter, which historically is the strongest period of the year from a seasonality standpoint. You can see here that historically the third quarter, which we just left, is the weakest of the four quarters. Now, every year is different. This, of course, doesn't play out every year, but generally speaking, the second half of December is seasonally one of the strongest periods of the year. So we would expect from that standpoint that the stock market has a bit of a wind at its back. As far as markets, bear markets, and so on and so forth, you know, it's hard to believe, but earlier this year, at one point, the market was down 20%. And we since bottomed in April. We saw a big move up. But it's important to remember the market doesn't go straight up. In fact, you can expect dips over the course of time. In fact, a 3% pullback happens 7 times per year on average, a 5% pullback a little more than 3 times per year, and then you get that 10% correction 1.1 times per year. So volatility is part of the game. Of course, what we try to do here is manage that volatility the best we can, smooth out the ride for our investors. You've probably heard an old saying, if you miss the 10 best days in the market, then your return drops substantially. But what they don't tell you is that if you miss the 10 best days and the 10 worst days, then your return is actually a little bit better than the market itself. And so what we try to do here at Q3, we're not going to miss all the worst days, and we're not going to be in all the best days. But if we can limit some of those down days and participate in more of those up days, then at the end of the day, you end up doing better than the market. And then finally, a slide on valuation. You know, you may have heard of something called a PE ratio, that the price to earnings of the market. This particular indicator, the Shiller-Cape ratio, includes an inflation-adjusted PE ratio. And over the long haul, you can kind of see the average of the market there, right around 18. And we are definitely what you might call kind of rich as far as valuations go. And that doesn't mean that the stock market cannot keep going up, because it certainly can. But it is an indication that we should definitely be aware of the potential for a more protracted pullback in the market. And that's what our strategies look to monitor and you know, maneuver. So we're going to talk a little bit about a few strategies here, kind of give you a feel for what it is that we do here at Q3. We're going to focus on a strategy called Bull Cipher, and then we're going to touch on one other strategy as well. Bull Cipher is a strategy we've been running for almost 10 years now. As I noted, it's our flagship tactical equity model. This is a strategy that, again, it seeks those steady returns regardless of market conditions. And here at Q3, we spend a lot of time studying historical market tendencies. This is one that is quite interesting. I actually did not believe it the first time I read this. We did a little white paper on it, and sure enough, it's true. If you had only invested in the stock market on Mondays from 1900 through 2024, you would have lost more than 99% of your investment, if you can believe that. And this is over a period of time where the stock market was up astronomically. So you can see there that for 9 straight decades, from the 1900s to the 1980s, Mondays were by far the worst day of the week to be in the market. But then something interesting happened. In the 1990s, Mondays became the best day of the week to be in the market. That's actually the case so far here in the 2020s as well. And the moral of the story here is not necessarily to avoid the market on Mondays, because even though that worked very well for a long time, it doesn't work so well anymore. But instead, the moral is that over the long haul, the market has a bias to go up. And if you diligently use these pullbacks as an opportunity to buy the dip or get involved and buy the market when it pulls back, you do very well over the long haul. And that's what Bull Cipher attempts to do, take advantage of these pullbacks by buying the dip. So we've been running this strategy for almost 10 years now. Performance, you can see there, very consistent. Again, steady performance is kind of the name of the game with this strategy. We're not going to outperform, every quarter. There's going to be periods where we lag, but the goal of this strategy is to provide that diversification in your portfolio. Now, I mentioned it's a buy the dip strategy. This is what we also refer to as a patient strategy. We are going to be sitting on the sidelines in a money market position, waiting for these opportunities to buy the dip roughly 40% of the time. So you can think of it as a surfer kind of waiting for that perfect wave. And when that opportunity comes about, we're gonna take advantage of it, just like the surfer is gonna take that wave. So what you can expect is that 30% of the time, we're gonna be 50% in the market. And then another 30% of the time, we're gonna be 100% in the market. And then the final 40% of the time, as I noted, we will be on the sidelines waiting for those opportunities. Another way to think about it is trying to predict what's going to happen with the weather or the stock market. If you're trying to do so 10 days into the future, your odds of being accurate are a little bit better than a coin flip most of the time. There's just so many variables that can change over the course of a 10-day time frame. However, if you shorten that time frame down to 1 or 2 days, both with the weather and the stock market, assuming you're using the right tools, your odds of being accurate can be much higher. And that's what we do with Bull Cipher, is we look to take advantage of these short-term opportunities, 1 to 3 days out, that are more predictable than something that might be further out into the future. So how do we incorporate this concept, this buy the dip or mean reversion concept, into Bull Cipher? Well, as most people know, investors have a tendency to overreact at times. And that creates an opportunity for us to buy the dip. And when investors overreact, the stock market pulls back. And this is a phenomenon that goes on through all types of different market environments, whether we're in a bull market or a bear market. And actually, during bear markets, you tend to see more opportunities to buy the dip. So this is a strategy that actually embraces bear markets. It doesn't mean we're always going to perform great during those time frames, but the history shows in a year like 2022, when the stock market was down 20% or close to it, this strategy did actually make some money. And that's a nice feature of the model. So we're looking to buy these dips over 3 different time frames. And you can think of it as a rubber band getting stretched too far in one direction. Often when it pulls back, it's going to snap back quickly. That's the bounce we're looking to take advantage of. But we have 3 distinct signals, one that looks at a 1-day time frame, another at a 3-day, and a third at a 10-day. And each one of these different signals is basically saying, hey, if the market pulls back too far within this designated time frame, you're going to buy it. And then once that normalcy returns, you're going to get out. And that's how we do it. Now I'm just going to give you one example here. And this is kind of a hypothetical illustration where you can see the stock market in blue. It's moving along there. And the green triangles are what could be a buy signal, and the red squares are what could be a sell signal. And when the market pulls back, you tend to see that's where we're going to be getting a buy signal. And then once that normalcy returns, you see the red square in the sell. And we rinse and repeat and do this process over and over, looking to take advantages of the pullbacks. Not only in bullish market environments, but also in bearish market environments. So you can see when the market pulls back, certain indicators tell us it's a good opportunity. Again, a hypothetical illustration here, but you can kind of get a feel for the idea of buying the dips and selling the bounces. So that's Bull Cipher, and it's been a very consistent strategy for us over the years. Again, it's a popular strategy with Clearstep and the portfolios that they put together. I did want to share with you just a little bit of information on one other strategy. We haven't been running this one as long, but it's becoming quite popular. And Carla and Clearstep team are using it in their portfolios. So we're just going to tell you a little bit about it. And of course, if you'd like to learn more in detail, Carla's happy to get into the detail with you. But we've teamed up recently with a firm out of Minnesota called Scarecrow Trading. They've been running tactical strategies for over 20 years. And we've known of them for many years. And in addition to our own models that we offer to investors through their financial professionals, we're always looking for compelling strategies that we might add to our lineup of offerings. And Scarecrow offers a strategy that we've watched for many, many years. And about 3 years ago, we started working with them in offering these models to our clients. And we're going to tell you a little bit more about the model. So the mastermind of these strategies is a man named Len Fox. He's been doing this for more than 20 years. And we began our collaboration there in 2023. They offer 2 flagship strategies, one called Crow Chaser, another called High Five. And what we've done is we've combined these 2 strategies into a single offering to add some added diversification and offer that to investors. So we're really excited about this strategy. You can see kind of the Crow Chaser model is one that's been around for over 20 years via Scarecrow. Again, we've only been offering it for about 3. And then the High Five strategy has been around between 5 and 6 years. But together, they tend to complement each other well. And so that's what we've done. So you can see here that there's a variety of different indicators that we look at to determine how these strategies are going to position themselves. They generally are going to trade the NASDAQ 100 index. So when we're long the market, we're going to be in the NASDAQ. And then we can also be entirely out of the market as well. And you can see here, we look at anything from momentum to trend following to sentiment. There's different seasonal aspects as well. And of course, as I noted earlier, from a seasonal standpoint, we are entering what is typically the strongest 2-week period of the year here coming up. So that's Scarecrow. If you'd like to learn more about that, certainly Carla's happy to share that detail with you. Wrapping up, looking ahead, this year was characterized by a lot of volatility, and I don't think there's any reason to believe that that volatility is going to be going away anytime soon. Although here more recently, we've seen it compress a little bit, but at the end of the day, it's a news-driven market. And the goal in environments like this is to try not to let your emotions dictate your investment decisions, because usually when you do that, oftentimes it leads to poor decisions. We see sometimes people allow their emotions to kind of get them out of the market at the wrong times, just because they don't want to lose. But really, if you have a solid foundation and a good plan, if you stick with that, that's the way to go. Again, I mentioned the seasonal time frame. We're in a strong period. Not only December, but January is typically a very strong period for the market as well. So we encourage you to stay the course with your investments. And when you do have questions or concerns, of course, Carla's there to help you through that as well. So that's what we have for you today. And I'm going to pass it back over to Carla to wrap things up.
Okay, thank you very much, Adam. So again, our goal at Clearstep, and that's why we use Q3 Asset Management, is to help grow assets. We want to be able to help grow them, to get ahead of inflation, to have the ability to use that money for future use, whatever it is, retirement or whatever other financial goals that you have. But also we want to help preserve, because there's black swan events and unpredictable situations that happen frequently with markets that cause, it could be the economy, it could be other events, but that could potentially cause markets to have downturns. And we want to make sure we help preserve and help prevent some of that. So, but Adam, would you be able to also, we've added New Horizons in the strategies as well, a small percent, but it has to do with AI and blockchain and so forth. Would you be able to just touch upon that?
Most definitely, yeah. So New Horizons is a strategy we've been running, I want to say for about 4 years now. And it is a strategy that focuses on cutting edge technology. So that's going to be anything from Bitcoin or cryptocurrency to automated vehicles, rare metals, space exploration, basically all of these disruptive technologies. And it's a strategy that diversifies amongst at least 4 different positions and reviews the market on a weekly basis. So we've got over 20 different areas that we look at. And our goal is to invest in what's performing the strongest. So we continually each week monitor what areas within that fund universe present the best opportunities, in our opinion. And those are going to be those that are performing strong. And that's where we allocate the money. Of course, if we enter a period where Bitcoin or cryptocurrency is out of favor, then we're not going to necessarily be in it. But as long as it's performing well, then you may see exposure there. So it's a strategy that can be considered growth oriented because of the fact that some of these areas, are more volatile. So as Carla mentioned, that's why it tends to be more of a complementary position in a portfolio, more of a diversifier. But it's getting a lot of attention these days because of some of these different areas in which it can invest.
Thank you. Thank you, Adam. All right.
Yep.
If you have any other questions, please reach out to us at Clearstep and we can see how we can help answer your questions or help you from there. So thank you. Have a wonderful day. Enjoy this wonderful season too. Bye-bye.